Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mindrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and attention today, and I am excited to be back on a special Friday edition of the podcast here, as my wife and I had welcomed our third child into the world and spending some time with our newborn, who came a week later than expected. It definitely threw off my content calendar, so I'm excited to be back with another live episode because we have a lot to keep an eye on here. As we see that recently, the House of Representatives just passed something called the Big Beautiful Bill Act by the slimmest of margins, one vote. And yes, that's the real name. And as silly as it is a pretty big bill. And it's coming with important changes, or really extensions to tax law, and very important student loan considerations to keep an eye on. So in today's episode, I'm going to break down the tax and student loan changes that could impact you pretty heavily as an optometrist and or a practice owner. And it's important to say this is not law. This is a proposed bill. It still has to make its way through the Senate, and I am expecting or really hoping for important changes through the Senate. And so we have a long way to go before this becomes law and we know exactly what we're looking at. But I think it's helpful to get a feel for what's on the table. What are the stakes here? What are the expected changes that we need to keep an eye on? And how might that change through the Senate? And so with that in mind, let's dive in first, looking at the tax considerations here. And it's important to give a little bit of background. In 2017, President Trump, in his first term, signed into law the Tax Cuts and Jobs Act, which was this big sweeping tax reform bill. It changed a lot about personal taxes in regards to the tax rates, brought down tax rates. It expanded the standard deduction, but it also removed something called a personal exemption. It made changes to something called the alternative minimum tax. It just about doubled the estate tax exemption. So it impacted a lot on the personal tax planning side, as well as on the business side. So it created a permanent 21% corporate tax rate, as well as for pass-through businesses. So those that are taxed as S corporations or partnerships or sole proprietorships. It created a 20%, what it called qualified business income deduction, the QBI deduction. And so it had these big changes from a tax planning standpoint. But in order for that law to be passed, a lot of those provisions had to expire at some point. And so a lot of those provisions, especially on the personal side, as well as that QBI deduction, were expected to expire at the end of this year. And things were expected to go back to pre-2018 tax law. So higher tax rates, lower standard deduction, but that personal exemption coming back, the state tax exemption reverting back to inflation adjusted but old numbers. So all of these individual provisions were going back to old law, and the QBI deduction was going away. And so we as practitioners, so financial advisors, tax professionals that we work with, we're all waiting to see which tax laws, which rules are we going to be working with moving forward. And so this law addresses a lot of that. It's basically extending a lot of what we currently have with some modifications and improvements or adjustments here. So for example, tax brackets are extended permanently, quote unquote permanently, meaning until another Congress changes it, but there's no expiration window. The current tax brackets, 10%, 12%, 22, 24, 32, and so on, will continue on. The standard deduction stays high. If you recall, when you look at your tax return, each taxpayer gets the option of choosing one of two deductions. You take a standard deduction amount, which is something that every family that are filing or tax filer that's filing like you gets to take, or you can pile up a certain list of personal expenses, and that's called itemized deductions. And if that itemized list is higher than the standard deduction, then you can take the higher of the two. So the standard deduction remains high, which is $30,000 for those filing taxes jointly, $15,000 for single tax filers, with temporary increases over these next 4 years, so between 2025 and 2028. And the bumps are $1,000 if you're single, $1,500 if you're filing head of household, or $2,000 if you are married filing joint, with adjustments for inflation. And you might be wondering why only for these next 4 years? Well, I wonder if part of it's because for budgetary reasons, they have to balance the numbers in order to get a bill like this passed. But also, if we think about it, what's happening in 2028? Well, it's the next presidential election. So without a doubt, I think there's some political gamesmanship happening here, but we see a slight increase there over the next 4 years. And if you're 65 and older, there's also an additional bonus increase to that, which phases out over certain income levels. So standard deduction continues on with a slight bump over the next 4 years. The child tax credit, which is a tax credit per qualifying child under age 17, continues to remain at its current level with a slight increase over the next 4 years. So this is something that was expected to be reduced down to $1,000 per qualifying child after this year. It's currently $2,000, and the current bill will continue that same dollar amount, but will give you a $500 increase over these next 4 years. So 2025 through 2028, we see that under this bill, it would be $2,500 per qualifying child. And 2029 and beyond, it's going to decrease back to its $2,000 level with increases for inflation. And it also keeps the phase-out thresholds for the credit. So that's $400,000 of adjusted gross income, AGI, if you're filing joint, $200,000 if you're filing single, and you start to phase out of the credit from there. The QBI deduction, going back to the business side, the QBI deduction is extended, so that's going to continue to live on, and it's slightly expanded under this bill. So currently it's a 20% deduction. It's going to be expanded to 23%. And I'll throw a link in the show notes to a more detailed podcast episode I did specifically on this deduction. And it also slightly simplifies and enhances the way that the phase outs are calculated for optometry practices. And the way that this deduction works is that optometry practices and healthcare practices as a whole, including financial planning firms, we're considered specified service trades or businesses. And because of that, once our taxable income before the deduction gets to certain levels, we start to phase out of the deduction. We lose little by little. And then once we hit the higher end of those thresholds, we lose it altogether. And currently, for example, in 2025, that phase-out threshold starts at $394,600 of taxable income before the deduction, and it phases out over the next $100,000 of taxable income. And all other tax filers, it's $197,300. And so there's this sort of complicated calculation to see what your deduction should be through this phase-out range before you phase out altogether. Well, this proposed bill provides a slightly simplified way to calculate those phase-outs, and I think in a way that's going to allow more of the deduction as your taxable income gets higher. So we'll see what that looks like as it goes through the Senate, but QBI lives on, which is what I was hoping for, and I think a lot of us were expecting, but it's great to see that written in the bill there. Another provision is related to the state and local tax deduction. In those itemized deductions that I mentioned earlier, one of those deductions is state and local taxes. You can use state and local taxes as one of those deductions. However, that 2017 law, Tax Cuts and Jobs Act, capped the amount of state and local taxes you could deduct at $10,000, which especially impacts those of us that live in high state tax states like California, New York, and so on, which led to a lot more tax filers taking that standard deduction, not really benefiting from the state taxes they were paying. This proposed bill increases that cap from $10,000 to $30,000, but there is a phase out for higher earners, meaning that eventually you start to phase down to the regular original $10,000 cap. Something to keep an eye on there. Another part of this bill is likely going to eliminate the use of a pass-through entity tax credit. And what this is that as a result of the state and local tax cap that you can deduct, states start to implement their own workarounds. And if you own a partnership or an S corporation and the business itself paid the state taxes on behalf of the owners, and the owners elected into it based on whatever the state rules were, it would show up as a business expense on the profit and loss, which indirectly led to those taxes being a federal tax deduction for the owners. And on the state tax returns, the state would provide a corresponding tax credit for those payments to offset the state taxes that were due. And so this was a workaround through the business itself. Each state looks a little bit differently, and something that we were expecting to be able to use at least through 2025, and this bill appears to be putting an end to that. Some other things to keep an eye on here are reforms to HSA accounts and some adjustments to 529 plans. This version of the bill essentially doubles the contribution limits for HSA. So for example, right now the limit is $4,300 a year in 2025 for an individual if you are covered by yourself on a high deductible health plan that qualifies, or $8,550 if you were on a family plan. And this bill would essentially double that to $8,600 for an individual and $17,100 if you were on a family plan with inflation adjustments. That being said, there are income phase outs for this. Eventually, if you get to a certain point of adjusted gross income, you phase down to those original limits. But something to keep an eye on there. It also helps to sort of eliminate some of these eligibility traps, so to speak, that might keep you from being eligible for using an HSA. So for example, those that are age 65 and older cannot qualify and use an HSA plan. But what this would allow for is that those who are 65 and older that are enrolled in Medicare Part A, but not in Part B, can continue to be eligible. And that's for you if you're continuing to work and you have healthcare coverage through work, you've opted not to enroll yet in Part B. This is something that's going to allow you potentially to continue to be eligible to contribute to an HSA. Similarly, there are some workarounds if your spouse has a healthcare FSA, a flexible spending account that they're contributing to, but you don't. It's going to have some workarounds that allow you to continue to be eligible for your own HSA. So some enhancements there. Same thing for 529 plans. It expands some of the abilities for you to use those funds. So for example, it would cover professional credentials and continuing education. So the CFP designation, for example, continuing education, things like that. So it expands the use a little bit for 529 plans, and it also expands the list of K through 12 expenses as well. Some other quick ones here. So bonus depreciation. Right now, the percentage of bonus depreciation is proposed to come back to 100%. If you're familiar with bonus depreciation, it's a cousin of the Section 179 accelerated depreciation. When you buy certain types of assets like equipment or real estate property, you're able to depreciate the cost of those things by default over a set schedule of time. So 5 years, 7 years, 15 years, 27 and a half years, and so on. What bonus depreciation and Section 179 allows you to do is it allows you certain types of property. It allows you to accelerate the depreciation into the current tax year rather than spread it out over a period of time. And bonus depreciation has come down over the years on the percentage of the cost you can accelerate. As a result of Tax Cuts and Jobs Act, it was set to 100%, meaning you can bonus depreciate 100% of the cost of the asset that you're working with. But that came down at a certain point, 20% every year. So currently in 2025, it's only 40% of the cost. 2026 would be 20%. Depending on the year that you purchased and placed the asset or property in service. And what the new bill would do is it would return us to 100% bonus depreciation, but only for property acquired and placed in service after January 19th of 2025, which interestingly is Inauguration Day, and before January 1st of 2030. So essentially through these next 5 years or so, we're going to be back at 100%, which can be a big deal, especially if you are a real estate investor. You're using things like cost segregation studies to separate out all of the components of the property into different types of assets and with different depreciation schedules. If this goes through, this is something that can be pretty useful for you from a tax planning perspective. The estate tax exemption is continuing on at its high level. and in fact increases. So it would be $15 million per individual or $30 million per married couple with continuations for inflation. So that continues on. And there is a host of other interesting tax provisions here, like tax-free tips and deductions for car loan interest at certain levels of income if the vehicle was assembled in the US. So there's other things in there, but those are some of the primary things that we're looking at as it relates to optometrists. So that's the tax planning side. Nothing major. I mean, a lot of it just continues on what we are currently experiencing with slight tweaks, slight improvements maybe, depending on how you're looking at it. Now let's talk about the student loan aspects of the bill. And this is where there are major reforms happening. And not all of them, and just to be frank, not all of them positive for optometrists. Let's dive into what we see here. So before I do, I think it's also helpful to give a little bit of a background for student loans, especially as it relates to income-driven repayment plan, of when and how those are created. So as you think about the history of federal student loans, our government, Congress, and presidents have done a really good job of creating a really complicated web of student loan rules, depending on when you went to school and when you took out student loans. Rather than create new rules and clean up old rules, they have tended to layer rules on top of each other and student loan repayment options on top of each other. So for example, when we look at the very first income-driven repayment plan, if you remember, income-driven repayment plan, IDR, is sort of the umbrella term that describes all of these different types of plans. And then there are technically 5 different plans, and your eligibility for those depends on who the borrower is. The very first one, ICR, Income Contingent Repayment, was created by law, I believe in 1993, and you were eligible for it starting 1994. Then came IBR, Income-Based Repayment. That was created again by law in 2007. First eligibility was 2009. There's an old version of that if you took out your loans before 2014, and there's a new, more favorable version of that if you took out your first federal loans after July 1st of 2014. So ICR and IBR, both created by laws, and then came 3 others created by presidential authority, executive action. The first one was Pay As You Earn. This was created in 2011 by President Obama's executive action. And it was created based on the authority that the president was given by that original law that created ICR. So President Obama was acting on authority given to him by that original law and created Pay As You Earn, a more generous version of that repayment plan. Then came revised Pay As You Earn in 2015, again by President Obama, based on the authority from that same law. And then finally, President Biden created the very extremely generous SAVE plan during the COVID era, which was the most generous of all and also based on the same authority given by that law. So we have these sort of layers of repayment plans added on top of each other over the years, some based on actual statute, others based on the authority given by that original ICR statute. And the authority that the president has is really the question of the court cases related to the SAVE repayment plan. The courts are now deciding whether the President Biden, actually had the authority given by that law to create such a generous plan. That's essentially what's happening here. And so this current bill, this one big beautiful bill, is going to overhaul substantially the current student loan system. And it's going to do that for current borrowers and future borrowers. And it's going to introduce this new repayment plan called the Repayment Assistance Plan, RAP, R-A-P. And what this plan does is it's going to calculate your payments based on a percentage of your adjusted gross income, a percentage of AGI. And it's a graduated level of percentages. So it's going to be anywhere from 1% to 10% of your AGI, depending on what your income is. For optometrists, you're most likely looking at 10% of AGI. So for example, if your adjusted gross income is $200,000, your payment's going to be $20,000 per year or roughly $1,600 per month. And it would still allow you to file taxes separately and exclude your spouse's income from the calculation. It would have forgiveness, but over 30 years instead of 20 years or 25 years. And it allows a small $50 a month reduction in payments per child. And payments under this plan would still qualify for PSLF. And this repayment plan is likely to be less favorable than the others. If you think about how the others are calculated, it starts with your income. It subtracts out an amount based on the poverty line for your family size. And then it multiplies that by 10% or 15% for the old IBR. And so the new plan basically just takes very likely 10% of your AGI just directly. And so from your AGI directly, and without subtracting that poverty line amount. So it's very likely to lead to higher payments and a longer timeline towards forgiveness. And then it makes important changes to the options that you have. As a current borrower, the Save plan and the Pay-As-You-Earn plan and ICR are all eliminated. All of those repayment plans based on the original law, those are all gone. And it's going to replace it with two options for current borrowers. You're either going to choose between a modified IBR plan, which is basically the old IBR plan, or this new RAP. So these are going to be your options, which is not favorable for current borrowers. I mean, for current borrowers, especially if you take out loans after 2007, have either Pay-As-You-Earn or new IBR if you took out your first loans after 2014, which are more favorable payment calculations, both have payment caps and a 20-year route to forgiveness. So these are going to be pretty substantial changes for current borrowers. For future borrowers, so for those that are not in programs yet, but are going to be starting to take out your first student loans in after mid-2026, your only option is going to be RAP or the standard repayment plan. If this goes through as it is, it's going to lead to some pretty important decisions for anyone that is going towards forgiveness, especially if you're in this range where your student loan to income ratio is somewhere around 1.5 to 1. That route to forgiveness is going to be more expensive. And so for all borrowers, you're essentially going to have to look at this with fresh eyes and see what makes the most sense. When it comes to public service loan forgiveness, PSLF continues to be tax-free. However, medical and dental residencies are no longer going to count if you are entering those residencies after mid-2026, which is not as substantial as an impact maybe for optometry, a much more substantial impact for physicians coming out of med school. Student loans discharged if you're disabled or deceased will continue to be tax-free. However, student loan forgiveness after 20 or 25 years becomes taxable once again. Currently, through 2025, forgiveness is tax-free. What we were wondering if a Congress will extend that out into the future, but they took no action on that. And so 2026 and beyond, forgiveness again becomes taxable. And so these are some of the provisions I'm keeping an eye on. And again, this is not law. This is still a proposed bill. I would imagine there are a lot of changes that are going to happen as it goes through Congress. In terms of the tax planning, again, it essentially extends a lot of the tax provisions now with adjustments here and there. But we'll keep an eye on that as things go through. On the student loan side, it becomes more serious. I mean, these are major changes to current borrowers. For you as a current borrower, you took out your loans with a promissory note, with a contract with the government under a certain set of rules. And essentially what this is doing is the government saying, we are not going to honor this contract that we entered into with you. We're going to change that as we go. I mean, this is something that a private borrower would never be able to do. Imagine your mortgage lender suddenly increasing your interest rate, 10 years in. So I am hopeful that enough senators hear from their constituents that for current borrowers at least, they grandfather you into the current rules that you're working in. Essentially, they just simply honor the contract that you signed as you took out these loans. And I'm hopeful that's something that we'll see changed. In the show notes, I've included a draft letter, if you want to, that you can take and edit and send to your senators in your state. This is not something I wrote, but this is something I got from someone else for me to share. So take that letter, send that out to your senators, and hopefully we'll be able to see some adjustments here. But the student loan side is a more serious set of changes that we're keeping an eye on. That being said, We don't know what will happen until it happens. And most of the people that I follow tend to expect that the Senate side of this will be released somewhere just before 4th of July, early July. So we'll keep an eye on that. I'll be bringing you updates as we go, both through this podcast as well as my weekly Eyes on the Money newsletter. So I'll throw a link in the show notes for you to sign up for that as well if you want to keep up to date on all this stuff. But if you have questions, please let me know. If you have concerns about how all this impacts your current planning, if you feel like you don't have a game plan at all, reach out to me. We'd love to get a chance to hear what's on your mind and see how we can help and be a resource for you. With that, really appreciate your time. Have a great weekend, and we will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mindrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.